So we move to Chapter 6, Absorption Costing and Marginal Costing. Now I can tell you this is definitely one of the go-to chapters in this course. There will absolutely 1000% certainty be questions on these two costing methods in your exam. So let's make sure that we understand the basics, but also the calculations. I think that's what the examiner is more than likely going to target. Let's look at the first area first, and it pertains to this concept of contribution. Now this is important, particularly when we look at marginal costing. So what do we mean? It may be something that you've come across before. This concept, in essence, in terms of a definition, basically means the difference between the product or service selling price and the marginal cost. And for marginal cost, we can broadly refer to variable cost. So we're saying, strictly speaking, this is not profit, this is contribution, because we're only bringing in our marginal cost. So how do I calculate contribution? Well, pretty straightforward really. Selling price less marginal cost, also known obviously as variable cost. Okay, so let's just say I had a unit, 1 unit of one product. I take the selling price, take off the marginal cost. I have the contribution per unit. What about total contribution? Well, simple enough. Total number of units sold times contribution per unit. Now, let's link that to an important area, fixed costs or fixed overheads, sometimes referred to as period costs. Now, we know from our past studies, and indeed perhaps even from your study of the chapter, that the difference between fixed costs and variable costs is fixed are probably larger. They don't vary with production, and indeed they're related to items that are probably fairly significant. So note that we take fixed costs as period costs when marginal costing is used. Now, what exactly do we mean by that? Well, we mean a period. We mean 1 month. We mean 1 quarter. We mean 1 year. We, broadly speaking, expense those fixed costs in that period. They don't get carried over in any way, and as it says right in the end, they're not related to production levels. I can produce 50, 5,000, 1 million. At the end of the day, those period costs or those fixed overheads are charged to that month. They're charged to that quarter. They're charged to that year. Now, in terms of scenarios, given what we've said so far, i.e. we defined contribution, we said selling price less marginal cost, we looked at period or fixed costs. What are the possible scenarios that we might be faced with in the exam? You'll see I've just cut and pasted from the study up. So let's look at point A. So we've got a scenario where contribution is less than fixed cost. Now, clearly on a profit and loss basis, that must be a loss. It has to be a loss. So losses are incurred as contribution was insufficient to cover the fixed costs. So you can see the relationship there between this area of contribution and indeed fixed or period costs. Point B, let's say contribution is equal to fixed costs. Note that we're referring in terms of the points to the diagram. I haven't reproduced the diagram here just because of space and indeed time. We're trying to get through the areas as quickly as we can. Now, on that basis, we have a break even. We must have a break even. It's equal to fixed costs, so we haven't got a profit and we certainly don't have a loss either. Point C, as you'll see if you refer to the diagram after this video, is contribution in excess of fixed costs. On that basis, we have a profit. We must have a profit. Outside of that, in terms of understanding this area, I think what we've got to get a fix on here is this sort of set of formulas. The idea, for example, that excuse me, the contribution is equal to X minus Y, selling price less marginal costs. The idea that at a break-even, contribution is equal to fixed costs, because this is what the examiner is going to target, your understanding of these formulas. And he's going to put you in a position where, let's say, you don't have a number, X, and you need to find it. So you need to be able to manipulate other numbers. Okay? Let's move on from there. Let's talk firstly about marginal costing. Now, let's not get overexcited. All we're talking about here is a way to cost a product. We're a company of manufacturers. We manufacture product A. We can choose the costing method. We can choose marginal costing. We can choose absorption costing. It's up to us. It's up to us to decide which is more appropriate. At the end of the day, the costing method should give us the most accurate cost. And this, again, is the type of thing that the examiner will target. What's the difference between marginal costing and indeed absorption costing, which is better in this situation, etc. So when we think about fixed costs with the marginal costing approach, as we've said, the expenses or the fixed costs charged against profit for the period. So it expenses fixed cost in that period, in that month, in that quarter, in that year. And in addition, and this is the first time that we've mentioned this, this is important, it does not retain any fixed costs in inventory. I'm talking about in closing inventory, unlike what we'll see below, which is absorption costing, which does build in fixed costs into inventory valuations. Let's take a look at absorption costing. So clearly, fixed costs allocated, apportioned, and absorbed in some way, shape, or form using an absorption rate into inventory. I'm talking about stock. I'm talking about raw materials. I'm talking about finished goods, etc. Now note, given that any unsold inventory, we get to the end of the period, if we have inventory, obviously we've absorbed fixed cost into it, then this unsold inventory would carry a proportion of fixed costs into the next period. Note how that's different to marginal costing, because fixed costs or period costs with marginal cost, they're expensed in that month. I'm not carrying them into the next month or the next quarter. No. So given that, let's move on to the variable cost area, i.e. the idea that only variable costs are relevant. So first things first, clearly, excuse me, only variable or marginal costs are included in inventory valuation, unit by unit. Now, what will that include? What type of costs are we talking about? Well, we're talking about what is generally referred to as the prime costs. In one sense, the sort of more important costs: direct materials, 2 kg, direct labor, 3 hours, direct expenses, variable production overheads. Those four main areas are our variable or marginal costs. Okay? Let's look into inventory valuation, given what we've said now. There's several areas here that we'll see the clear difference between these two methods. Now, on the basis that we've said that marginal costing will basically expense fixed costs, and indeed that absorption costing will build in, using some sort of absorption overhead rate, fixed costs into inventory, they have to produce different profit figures. They have to, because they've got different closing inventory figures. So looking at the diagram that I've cut and pasted here, if I just bring this across a little bit. Let's look at the left-hand side first. And again, now I'm repeating myself, but no harm in doing that. When we think, firstly, the first area, valuation of production of, like, say, finished goods. Absorption costing, all production costs, including production overheads. Marginal costing, variable production costs only. Remember, prime costs. Note, fixed production overheads not included. Okay? Second area, again, repetition. Treatment of fixed production overheads. Under absorption costing, absorbing costs, absolutely, including the value of fixed goods. Marginal costing, expensed for the period, in that period, month, quarter, etc.